Let's now look at illustration number 29. On 1st July 2021, D Limited issues preference shares to G Limited. All right, so D Limited is basically the issuer and G Limited is the holder of the instrument. It issues preference shares for a consideration of rupees 10 lakhs. The holder has an option to convert these preference shares to a fixed number of equity instruments of the issuer. All right, remember, these are not mandatorily going to get converted into equity shares. The holder will be given a choice either to convert these preference shares into equity shares or to receive cash instead of the preference shares. All right, they will either be redeemed in cash or they can be converted into equity shares. And the number of equity shares is actually fixed. All right, it's fixed today itself. It's not going to be dependent on the fair value of the equity share on the date of conversion. All right, so it's going to get converted. If converted, it will get converted into a fixed number of equity shares. And the question is saying that it will be converted. It can be converted at any time up to a period of 3 years. All right, it can be converted at any point in time for the next 3 years. If the option is not exercised by the holder, the preference shares are going to be redeemed at the end of 3 years. All right, so in the next 3 years, at any time, G Limited can choose to convert it into equity shares. And if G Limited does not choose to convert it in the next 3 years, at the end of the third year, the preference shares will be redeemed. The preference shares carry a fixed coupon of 6%. All right. So the coupon rate mentioned is 6%. They're going to actually receive dividend of 6% and is payable every year. The prevailing market rate for similar preference shares, the prevailing market rate for the similar preference shares without the conversion feature is 9%. Let's focus a bit on the last sentence of the paragraph. The prevailing market rate without the conversion feature is 9%. What does this mean? If let us say D Limited would have issued preference shares in the market without this conversion feature, all right? If let us say D Limited would have issued these preference shares in the market without the conversion feature, the interest rate or the coupon rate on such preference shares would have ideally been 9%. All right, but in this case, D Limited has issued convertible preference shares having a coupon of 6% only. All right, had this preference shares not had a conversion option, then the coupon rate would have ideally been 9%. But because these preference shares have got a conversion option, we are actually issuing a lower coupon of 6%. Does that make sense? The answer is yes, because if you actually think of it from the viewpoint of G Limited, there is actually a benefit as a result of convertible preference shares because G Limited is actually having an option to become a shareholder of the company and it will actually participate in the profits of the company. If the company is doing exceedingly well, what G Limited will do is it will actually convert its preference shares into equity shares and therefore it will actually take a part of the profits. If the company is not doing well, because it is an optionally convertible preference shares, G Limited will actually choose not to convert and it will actually receive the principal amount of 10 lakh rupees that it originally gave. All right, so clearly the conversion option is a benefit that is available to G Limited. All right, the conversion option is clearly a benefit that is actually available to G Limited. Or if the company is doing well, it can actually take a pie of those profits. If the company is not doing well, it's actually not going to take the losses. It's only going to receive the principal back on maturity. All right, so clearly the conversion option is a benefit that G Limited actually has. No, obviously, there's no free lunch, right? G Limited has to pay some cost to get that benefit. All right. If G Limited is getting some benefit, there's always going to be a cost associated with it, right? The cost is that G Limited will actually have to accept a lower coupon. All right. There's obviously no free lunch. You cannot expect benefits without paying any cost, right? So if you're receiving any benefit, obviously G Limited has to pay the cost. The cost that it is implicitly paying is that instead of receiving 9% coupon, it's only going to receive 6% coupon. All right. It is sacrificing a portion of its coupon so as to actually get the option to convert into equity shares. All right. So the benefit that G Limited is getting is the option feature, and the cost that it is implicitly paying is the lower coupon that it is agreeing to receive. All right. The fact that G Limited is receiving a lower coupon is basically a benefit to D Limited. D Limited is going to have a lower outflow as a result of the conversion feature. D Limited will actually have a lower cash outflow over the next 3 years. All right. If there was no conversion option, D Limited would have actually had to pay 9% coupon. But now, because of the conversion feature, D Limited's benefit is that it has to pay a lower cash outflow. All right. So every time there's a conversion feature option, all right, take it from me, every time there's a conversion feature option, the coupon rate that we're going to pay is usually going to be less than the, sorry, it's going to be less than the market rate of interest. All right. The coupon rate that we will pay will be typically less than the market rate of interest. And that is obviously logical. Now the question is calculate the value of the liability and equity components. Now over here, if you think of it, D Limited actually has an obligation to pay cash in the form of coupon for the next 3 years. All right. Yes, these are preference shares. Although the question has not mentioned it explicitly, I'm assuming that these are cumulative because it is actually saying that it is payable every year. All right. The fact that it is saying that it's payable every year is indicating that these are cumulative preference shares, and also they've called it as coupon, but ideally it's supposed to be dividend, right? All right, but I'm considering them as cumulative preference shares, and therefore I'm going to say that D Limited actually has an obligation to pay coupon for every year at the rate of 6%. All right. So with respect to coupon, there is a contractual obligation to pay cash in the hands of for D Limited. All right. D Limited has an obligation to pay cash of 6% every year. That is with respect to coupon. Now let's look at with respect to principal. Now, if you look at it, G Limited basically has an option to either convert it over the next 3 years or to choose to redeem at the end of third year. Now, if it chooses to redeem at the end of third year, then D Limited actually has an obligation to pay cash with respect to the principal amount as well. All right, D Limited is going to have an obligation to pay rupees 10 lakhs with respect to the principal amount as well at the end of third year. This is when if G Limited actually chooses to redeem the instrument at the end of third year. Alternatively, if G Limited chooses to convert these into fixed number of shares, then D Limited has an obligation to issue a fixed number of equity shares. All right, D Limited will have an obligation to issue a fixed number of equity shares. And remember, an obligation to issue a fixed number of equity shares satisfies the definition of equity and not financial liability. All right, so if you actually notice, coupon payment clearly is a financial liability. With respect to principal, it can either be a financial liability or it can be an equity as well. All right, because there can be an obligation to issue a fixed number of equity shares or an obligation to actually pay cash, and therefore it has the characteristics of both financial liability and that of equity. And that is the reason this is going to be classified as a compound financial instrument. Now, in compound financial liability, if you remember what we had actually discussed previously as well, what we do is the consideration that is received on day one, it will be recorded as a receipt, bank account debit. We have received a consideration of 10 lakh rupees. What we are going to do is we are going to split this 10 lakh. A portion of it will be recognized as financial liability. A portion will be recognized as financial liability. And this financial liability basically represents the obligation to pay cash, and a remaining portion will be recorded as equity. All right, because it has the characteristics of both financial liability and equity, we are going to split the value of 10 lakhs into financial liability and equity value. The question is, how do we calculate the financial liability and equity value? That is actually the question as well. All right, it says calculate the value of liability and equity components. All right, now how do we determine the value of the liability? The value of liability is going to be equal to the present value of the cash flows that the entity may be obligated to pay. It's going to be present value of the cash flows that entity may be obligated to pay. This is going to be determined to pay in cash. Obviously, this is going to be the liability value. All right, the liability value will be calculated as the present value of the cash flows that an entity may be obligated to pay in cash. All right, I'm actually repeating, maybe I have mentioned cash flows over here, so I don't again have to mention in cash. All right, so the value that the entity is actually required to pay in the form of cash will be discounted, and that will be the amount of liability. Now remember, the word that I've actually written is may be obligated. All right, over here we are not only going to consider the coupon, but we are also going to consider the principal amount. All right, we're also going to consider the fact that there can be an obligation to pay 10 lakh rupees at the end of the third year. All right, why are we calling it as an obligation? Because if you look at it, if G Limited chooses to actually redeem the instrument, then D Limited does not have a choice. All right. It is not an obligation that it can avoid. All right. D Limited does not actually have a choice. It will have an obligation to pay cash. Yes, that obligation is conditional on something. All right. But D Limited will actually have an obligation to pay cash if G Limited actually chooses to exercise. Therefore, when we are calculating the liability value, we are going to take the present value of all the cash flows that an entity may be obligated to pay. It is obligated to pay coupon, and it may be obligated to also pay cash for the principal amount, and therefore we will consider it for the purpose of liability computation. Now, when we are calculating the present value, the discount rate is going to be equal to the market rate of interest. All right, the discount rate will be the market rate of interest. Market rate of interest is given as 9%. All right. So the 9% will be the discount rate that we are actually going to use. All right. So let's quickly start with the liability calculation. We have got 3 years. Remember, the maturity of this instrument was 3 years. So I'm actually writing an annuity cash flow of 60,000. How is the 60,000 calculated? It is 10 lakhs of face value multiplied by 6% that I'm going to pay as coupon. All right. The coupon that I will pay is equal to 60,000, but the discount rate will actually be 9%. All right. The discount rate will actually be equal to 9%. All right. Over and above this, we are also going to have a cash flow at the end of third year of 10 lakhs. All right. Yes, this cash flow is conditional upon exercising the option or not exercising the option, but the entity will actually may have an obligation to pay if G Limited chooses to redeem the instrument. All right. So since this is a cash flow that an entity cannot avoid, this is a cash flow that an entity cannot avoid, I am actually considering this as an obligation. All right. So we are going to discount these cash flows at 9%. All right. So let's quickly calculate what is the present value factor. So the present value annuity factor for the first 3 years will be 2.5313. Sorry, I wrote it in the below row. It's going to be 2.5313, and for the third year, the present value factor is going to be 0.7722. The discounted cash flow for the first 3 years will be 60,000 multiplied by 2.5313, which is equal to 1,51,878. And for the last year, for the third year, it's going to be 7,72,200. All right. So this will be the discounted cash flow. The sum total of this is going to be equal to 9,24,078. All right. It's going to be 9,24,078. The discounted cash flow, or the present value of the cash flows that an entity may be obligated to pay, is 9,24,078. All right. So in this journal entry, financial liability will be recorded as 9,24,078. All right. So the amount of financial liability will be 924,078. Now, equity will basically be a balancing figure. It will be a balancing figure, which is 9,24,070, 10 lakhs minus 9,24,078, which is equal to 75,922. All right. So this financial liability will be disclosed on the balance sheet under the liabilities section, and this will be recorded under the shareholders funds. All right. 75,922 will be recorded under the shareholders funds. This is how we are going to split the 10 lakhs into 9,24,078 of liability and 75,922 of equity. Let's take a quick look at the solution as well. If you notice, it's stating that the total financial liability is 9,24,061. It's probably because of rounding that we have got slightly different numbers, and the equity component is 75,939. All right. So this is how we are going to record the value of liability and equity. All right. With that, we are done with illustration number 29. Before we end the lecture, I would like to actually just make a point. Hypothetically, let us say if the convertible preference shares also had a coupon of 9%, hypothetically, that wouldn't really happen, obviously, because like I mentioned, if G Limited is actually receiving a benefit in the form of conversion feature, then it has to pay a cost, and the cost will be a lower coupon rate. But over here, hypothetically, I'm actually saying that the convertible preference shares also have a coupon rate of 9%. All right. In that case, if you actually think of it, the discounted cash flow will exactly be equal to 10 lakhs itself. All right. Over here, the discounted cash flow came to an amount which is less than 10 lakhs because you were actually using a higher discount rate. All right, we were using a higher discount rate, and the cash flows were actually of 6%, and therefore the present value came down to 9,24,000. If let us say the discount rate, the cash flows were also at 9%, and the discount rate is also 9%, this would actually amount to 10 lakh rupees. All right, the amount of liability would actually be equal to 10 lakh rupees, and equity in that case would actually have a zero value. All right, the value of equity would actually be zero in such a case. You would not have any equity value if the coupon rate is the same as that of the market rate. All right, for whatever reasons, I'm just creating a hypothetical scenario where if the coupon rate is the same as that of the market rate, then the amount will entire amount will actually appear as a financial liability, and there won't be any amount against equity. All right, so that was just a hypothetical scenario that I thought it is worth mentioning. Although it is a compound financial instrument, there wouldn't be any value against equity.